Welcome to my channel Commerce Specialist, where you will find videos covering different topics of academic qualifications as well as professional certifications. Ladies and gentlemen, today's topic is so very important, I can't tell you. Guys, we know very well that say 90% of the businesses, their main objective is to make profit. Unless you are a not-for-profit organization, your main aim and objective is to make a profit. But there is an important milestone. There is a prerequisite. Unless you achieve that milestone, you cannot make a profit in business. And that's what we are going to discuss today. Ladies and gentlemen, we call it break-even. So what is break-even or break-even point? Break-even point is a level at which there is no profit, no loss. Or in other words, your total revenues which you have earned from your business equals your total cost, what you have invested so far. So we can say a point at which there is no profit, no loss, break even. So what I'm going to do now is I'm going to give you a numerical example. And as I said, it is so very interesting and important for any and everybody who's related somehow or the other with a business. So let's go to a numerical example. So let's take an example of a restaurant. I've put some details here. If you look at this, we have some fixed cost, which I've just taken as a rent. Rent is $1,000. We're just assuming. Variable cost. Obviously, in restaurant, you're making something. Let's say you're selling chicken rolls. So variable cost would be the ingredients, the chicken, the bread, any other, salad or something. That cost $6 for one chicken roll. And selling price happens to be $10. Now, these amounts are just example. Just don't hold me for that, like, why it is so expensive or, cheap. So it's just an example. Now, we are talking about a restaurant which has a fixed cost, which is rent. Fixed cost is a cost which generally does not change in relation to your activity, your sales, your production. So whether you sell one chicken roll or 10, rent is the same which you have to pay. Whereas variable cost, why we call them variable cost? Because it varies. If I'm making one chicken roll, the cost of one chicken roll is $6. If I'm making two, it's 12. And this is how it goes up. If I'm not making anything, there is no variable cost. But fixed cost is still to be paid. Now, looking at this small and simple example, ladies and gentlemen, there are so many things which we are going to learn today. Now, as a certified management accountant, I have worked with management consultancies. Most of my clients were like, they come to my office and they're discussing business proposals. We used to make so many feasibility reports, but one important element of any feasibility report was break even. And this is what we are discussing today. So assuming I have a client who intends to start up a restaurant, and these are the basic details my client has shared with me. Let me tell you, he has not started the business yet, and we are doing some business planning now. So the rent is $1,000 per month. He intends to make chicken rolls, and his variable cost of making one chicken roll is $6, and he intends to sell it for $10. So the most important question, every client asks me, I'm going to do this business, will I make profit? My answer to them is, forget about profit. First, you need to focus and you need to think when you're going to break even. Because unless you do break even, you cannot even think about profit. First, a business does break even, covers all its fixed and variable cost. After that, profit starts coming in. So any clients I'm discussing all these things with, the very first discussion is when the business is going to break even. how many chicken rolls they will sell in order to break even. Guys, before we go calculating break even, one thing is so important everybody should know. If you ask any business person, any person who's running their own business, their main concern and worry is their fixed cost. It's not the variable cost businesses are worried about. Why? Because variable cost is recovered as soon as a sales takes place. For example, in this case, the cost of making one chicken roll is $6. And how much it is sold for? $10. So the moment one chicken roll is sold, you are getting $10. This $10 covers your variable cost immediately. In fact, you are getting something extra. The variable cost is 6, the cost of making is $6, you're selling it for 10, you're getting $4 extra. But with that $4, can you pay your rent, which is your fixed cost, which happens to be $1,000. That is the biggest concern of most of the businesses. They're not concerned about the variable cost, they're concerned about recovering their fixed cost. So guys, now let's talk about break-even point. How do we calculate it? The formula is pretty simple. Break-even point in units is equal to total fixed cost divided by contribution per unit. So please pay attention. When I say total fixed cost, there is a possibility a business may have more than one fixed cost. This is a simple example. I've just taken fixed cost as rent. But in reality, you can have rent, you can have staff salaries, you can have annual repair and maintenance, you can have fixed insurance amounts to be paid. So the formula says total fixed cost. Add up all your fixed cost. In this example, the only fixed cost we have is $1,000. And when I say contribution per unit, please understand and remember, contribution per unit is selling price minus all variable cost. So if you look at selling price is $10 and variable cost is 6. So $10 is my selling price, variable cost is 6. So this looks like this, $1,000 divided by 4, and which gives me 250 units. This is your break-even point in units. Now, ladies and gentlemen, it is so very important to know this amount before you have even invested a single dollar in business. We are still doing table talks. I'm discussing with my client, okay, you want to open up a restaurant? And this is how the restaurant looks like. Yeah, that means you're going to take a restaurant, you're going to pay rent of $1,000. In short, your variable cost for making one chicken roll is going to be $6. You're going to sell it for $10. This is what you should focus on. Unless you sell 250 chicken rolls a month, you better not think about making profits. Profit is far away. You must sell 250 chicken rolls to break even, to cover all your variable and fixed cost. And once you sell more than this, your profit starts coming in. If you're selling less than 250 units, you are going into a loss. So guys, now let's prove. Is the business breaking even if they sell 250 units? As I said, break-even point means a point at which there is no profit, no loss. Which means when total revenue is equal to total cost. So have a look at this. We can say break-even point is when total revenue is equal to total cost. Now we need to know how to calculate total revenue. Total revenue is simply selling price per unit multiplied by the number of units. And total cost is actually your fixed cost plus variable cost per unit multiplied by the number of units. So if I just plug in the numbers here, selling price, if you could see, it's $10. So all right, $10. How many units are we talking about? We're talking about if we make and sell 250 chicken rolls, the business is going to break even. So let's put 250 units here. And here, fixed cost, we can see it here, it's 1,000 units, $1,000. Variable cost per unit, it's $6. And number of units, again, we are talking about breaking even at 250 units. So I'm putting 250 units. So this 250 multiplied by $10 will give me $2,500. And fixed cost is 1,000. And 6 into this is 1,500. 6 into 250 is 1,500. So now finally what happens? Your total revenue is $2,500, and when you add this, your total cost is also $2,500. Which means total revenue is what you have earned from your customers by selling 250 chicken rolls. Total cost is your total cost to make and sell 250 chicken rolls. So if you could see, both are equal. Your total revenue is equal to total cost. So from total revenue minus total cost, the answer will be 0. 0 means break even, no profit, no loss. I hope this much is understood. Now we are going to the next part, calculating profits and losses. And one thing is very clear. Any amount more than 250 units will generate profit for the business. If our sales is less than 250 units, the business is going into a loss. So let's prove that now. Profit or loss is actually, it equals to total revenue minus total cost. Now please remember the working we just did for break-even. We calculated our break-even point to be 250 units. Now I'm just assuming, what if the business makes and sells 200 units? Would the business be in profit or loss? Let's check. So total revenue, as we know, is selling price into the number of units, and total cost is fixed cost plus variable cost per unit into the number of units. So if I put the numbers here, selling price remains the same, $10, and I'm assuming the business is selling 200 units. So I'm putting 200 units here. Rest everything is the same. Fixed cost remains at $1,000, variable cost remains as 6, and we're talking about 200 units. So what's happening here? 200 into $10 is $2,000. And here if I talk about fixed cost is $1,000, 6 into 2 is $1,200. So what do we have? We have $2,000 of revenue and $2,200 of cost. And simple mathematics, by the way, 2,000 minus 2,200 is a minus 200. Minus in accounting normally means loss. And it is very much proved. We discussed that the business will break even at 250 units. If the business sells more than 250 units, they're making a profit. If they're selling less than 250 units, they're going into a loss. Have a look at this. We assume that the business is making and selling 200 units. 200 is less than the break-even point. They're selling not 250 but 200. Because they're selling, their sales are below the break-even level, see, they are incurring a loss. Have a look at this. Now, let's assume, what if the business sells more than 250 units? Our understanding is more than 250 units, there is a profit. Less than 250 units, there is a loss. Let's have a look. So all the numbers, figures, assumptions as before, the only change is now we are assuming the business is selling, let's say 400 units. What happens then? Have a look at this. Selling price is, yes, $10. Now we are assuming that the business is selling 400 units. 400. Fixed cost remains the same, $1,000. Variable cost per unit is $6, and we are talking about 400 units now, right? So 400 into this is 4,000. This is 1,000 fixed cost. 6 for the 2,400. Okay, what happens? 4,000 is your total revenue, and when you add this, this is 3,400, your total cost. So when you subtract, how much do you get? You get $600, and this is good news, ladies and gentlemen. This is your profit. Why this is a profit? Because your revenues are more than your cost. Let me tell you, this is total revenue. Your revenue is 4,000. Selling 400 units, and your total cost, this is your total cost. Your total cost happens to be 3,400. So if your revenues are more than total cost, obviously you're making a profit. Now, think about it. If you're going for a startup, if you're going to start a new business, don't you think this information is so very important for you? Look at the beauty of this concept. You have not started a business yet. You have not even invested a single dollar. And as a management accountant, I have told you what's going to happen. Look at this, the milestone you have to achieve. Now let's assume you want to open up a restaurant. Your break-even point is 250 chicken rolls a month. Then you look at the other dynamics, the other factors. Do the market research. Look at the number of, the population in that area, whether they eat outside or not. You will be able to collect relevant data, and you will be able to know whether you will be able to sell 250 plus units every month or not. That obviously depends upon the market survey and the results. But for now, for a new business, it is so very important to know what is the, first milestone to achieve. Nothing less than 250 we intend to sell if we want to remain in profit. Now we are talking about how to calculate profit and losses very quickly. I would say the shortcut for calculating profit and losses. Have a look at this. Coming again to the same old break-even point formula. What is the formula? Break-even point is equal to total fixed cost divided by contribution per unit. Now I want everybody to pay attention on what is contribution per unit. Contribution per unit is selling price minus variable cost. This is selling price per unit, and this is variable cost. And I have highlighted here as 4. Any business, if you are running a business, you would know what is your selling price. If you're selling, let's say, Coke, you're selling chicken rolls, you're selling burgers, sandwiches, laptops, calculators. You know what is your variable cost. You know how much you are going to sell that product for. Which means, if you know the selling price and your variable cost, you know your contribution. So once you know your contribution, it is so very easy to calculate profit. How? Have a look at this. How to calculate profit and loss very quickly. What you do is, you calculate total contribution, which is so easy. Contribution of 1 unit is how much? 4. And we are talking about how many units? 100. So you just multiplied. So you get 400. From this, you minus fixed cost. Your fixed cost is $1,000. Obviously, from 400, when you minus $1,000, you're going to get negative. And that's what? Loss. Because you see, now I'm talking about bigger companies. When you're sitting in a board meeting, there are all the directors there, nobody has that much time, and if I'm the finance director, they're asking me, what if we sell 2 million units? What's going to be the profit? I cannot tell them, let me prepare the profit and loss account. I don't have the time. So I have my laptop or, iPad with me, and everything is programmed, especially this. Let me tell you, the company knows its contribution per unit. The company knows its fixed cost. The only thing is, I have to just keep on putting this number. So if my company says, what if we make 600 units? What will be the profit? So the only thing I do is, I just punch 600, input 600 in my laptop, like this. And then, because I'm using Excel, the formulas are put, directly it calculates profit. How? 4 into 6, 2,400 minus 1,000, I'm getting a profit of 1,400. This becomes a profit. So shortcut to calculate profit or loss is total contribution minus fixed cost. Every big and small business, they know their fixed cost. Ask somebody who's running their own business. Ask him what is his monthly fixed cost which they have to bear whether there is sales or not, whether they sell more or less. So every businessman, they know their fixed cost. So fixed cost is 1,000. Contribution, everybody knows, selling price minus variable cost. So total contribution means the number of units multiplied by contribution per unit. So 4 into the number of units, 2,400 minus fixed cost. If it's a positive amount, that's a profit. If it's negative, that's your loss. My clients have, various expectations from their business. They're starting business for so many reasons. Financial independence, being their own boss, so on and so forth. So if you look at the same example, once my client told me, look, I'm starting business, but I have, a commitment. I said, what is that? He said, look, I want to break even, yes, but I have a target profit in mind. I said, why is it so? He said, look, to start a business, I'm borrowing money from somebody, some relative of mine. And I've promised that after 1 month, I'm going to repay them. I said, okay. I said, how much is the amount? He said, $2,000. Which means, now my client is asking me, how many units, how many chicken rolls should I make and sell in order to make a profit of 2,000? The formula is very simple. In fact, it's an extension of the break-even formula. Have a look at this. So now we are assuming that the client intends to make a profit of $2,000 in the first month. So how many units he or she should sell to get that profit? Units necessary to sell in order to make a profit of $2,000. So as the owner, as the entrepreneur, as the business person, your expectation can be many. Here your expectation is that you want to make a profit of $2,000 first month. Then how many units you should sell? Have a look at this. Total fixed cost divide by contribution. This is the normal formula of break even. The only thing you do is you add here your target profit. So all details, numbers as before, I'm just plugging in the figures. Total fixed cost happens to be $1,000. Your contribution, selling price minus variable cost, I'm putting it directly as $4. And what is your target profit? How much profit do you want to make? You want to make $2,000. So you add these two, that becomes $3,000. Divide by 4. You get 750 units. So I told my client, look, if you are being very ambitious, you want to make a profit of $2,000 in the very first month, then you better be ready to sell 750 units. Because only then you will be able to cover all your fixed cost and make a surplus, a profit of $2,000. Now again, I'm reminding you, the person has not invested yet into the business. It's just table talks. I'm telling my client the ifs and buts, what to do, what not to do. If you have this target, what you should do. Because you see, just by wishing is not enough. There has to be some planning, some numerical planning. So in a business, if you intend to have an ideal profit, a specific profit, then you better, buckle up and be willing to sell this much, as in this case. Next, we are talking about, because at the moment I'm myself in a Gulf country. And it's a safe haven. Why? Because there are no taxes, especially on salaried people. For businesses also, the tax rate is not pretty high if you compare it with European countries, like, an average tax rate would be somewhere around 30-35%. So at the moment we are considering there is no taxation for, let's say, no taxation. So your profit is 2,000 and you can fulfill your commitment. As my client says, he or she borrowed some money to start a business. In the first month, if they sell 750 units, they'll be able to make a profit of 2,000 and return the money back. Now I'm taking you one step ahead. What if, obviously we all know that profits are subject to taxation. So even if they make a profit of 2,000, they will have to pay tax. If in US you have to pay tax to Uncle Sam, then what happens? You will not be left with 2,000. After tax would be a very low amount. So now we are talking about a simple formula which would be an extension of this one, and we'll be incorporating the tax element into it. Let's have a look. So guys, now we are just assuming that the country where you are operating, there is a flat rate, although it's not always like that, but just to make the example simple, there is a flat rate of tax on profit, which is 20%. So assuming that tax is at the rate of 20%, and your client's expectation is the same, that your client wants to, make a profit of 2,000 if tax rate is 20%, that means a post-tax profit of 2,000. How many units he should sell in order to make a after-tax profit of 2,000? So let's have a look at the formula. The formula is very much the same with just one minor modification in it. The formula is same, total fixed cost divide by contribution. Because if I do this much, I'll get the break-even point. But here we are having a target profit and we also have tax. So this target profit has to be divided by 1, which is in the formula, minus the tax rate. So how it looks like if I plug in the numbers? Total fixed cost happens to be the same, 1,000, no changes. Target profit, $2,000. 1 is in the formula. Tax rate 20% means 0.2. So 1 minus 0.2. Whole thing divided by contribution, which is $4. So this fixed cost is 1,000. 2,000, 1 minus 0.2 is 0.8. When you divide 2,000 by 0.8, you get 2,500. Divide by $4. If I continue here, 2,500 plus 1,000 is 3,500. Divide by $4 contribution. So we get 875 units. What does this mean? This means if you sell 875 units, you will make a profit of 2,500. From this 2,500, even if you pay 20% tax, after paying tax, you will be left with net 2,000, which yes, you can repay to anybody as per commitment. I hope you have understood the tax element. Now another thing on the break-even calculations, something which is always businesses are interested in is the margin of safety. So if I write here margin of safety, how it is calculated? Pretty simple. It's very, very simple. Existing sales minus break-even point. So I'm just assuming our existing sales are 875 units. It's just an assumption. And we know, looking at all these things, our break-even points originally was 250 units. So when you subtract, you will get your margin of safety. 625. Now, what does this 625 units mean? Have a look at this. I'm just explaining you. This is just a simple example. This is your break-even point, which is 250 units. We understand if you sell less than 250 units, all this area is the loss region. If you sell more than 250 units, you are into profit. What is your existing sales? Your existing sales, at the moment, the company is selling, let's say, 875 units. So this cushion in between 625 units is your margin of safety, which means your sales is at 875 units. It may fall, but if it falls a maximum of 625 units, you may go into a loss region. So by the way, nobody wants their sales to fall down. But even if that's the case, what if your sales are falling? The company can afford a fall in sales of a maximum of 625, not below this. Because the sales falls more than 625 units, the company will get into losses. So anything above the break-even point is actually your margin of safety. You are in the, away from the danger zone. Now next, what we are discussing is, if you look at this example here, you're just selling like chicken rolls, one product. Now, you may have in mind, what if I have a restaurant, I'm selling so many things. I'm also selling, let's say, chicken rolls, I'm also selling Pepsi or Coke. So if you are dealing in multiple products, how to calculate break-even? Let's have a look. So now what we are talking about is a small restaurant selling just two products. One is chicken roll and Pepsi. Data I have, this data is given here. For chicken roll, the selling price of one unit, one chicken roll, the selling price is $4, and for one Pepsi is 1.5. Now don't hold me that it's not so expensive or it's cheap, it's just an example. So selling price for chicken rolls are $4 and Pepsi $1.5. The variable cost of one unit making and preparing the roll is, let's assume $1, and for Pepsi the variable cost of buying one unit is 0.5. And we know what is contribution. Contribution is simply selling price minus variable cost. This bracket means I'm subtracting. So from 4 when I minus 1 I get 3, that is the contribution per unit for chicken rolls. From 1.5 when I minus 0.5 I get the contribution. One thing is important, like when we are talking about multiple products which are selling more than one product, we need to know the sales mix, the breakup of sales. For example, here when they sell, on an average a customer buys 2 chicken rolls and 1 Pepsi. This is how it is sold. It can be more or less, and we can easily find by market survey, by research, that what is the sales mix for a particular restaurant or a particular business. If you're selling, like for example, if you're a furniture manufacturer or retailer, what is your sales mix? Let's say we're talking about table and chairs. So on an average, maybe with one table you're selling 4 chairs. So the sales mix would be 4:1, 4 chairs, 1 table, or vice versa. So here it is assumed that the sales mix is 2:1. For every 2 chicken roll, 1 Pepsi gets sold, 1 can of Pepsi. Fixed cost I've just taken as $1,000. Now that fixed cost could be your rent, your salaries, whatever. What are we trying to calculate? We're trying to calculate how many chicken rolls and Pepsi cans are necessary to be sold in order to break even. So what do we do here? The very first thing we need to calculate is weighted average contribution per unit. Weighted average contribution per unit. How to calculate that? Pretty simple. You look at contribution of chicken rolls, which is $3, and you look at the ratio here, 2:1. So you can add 2 plus 1 is 3. So the contribution of this is 2 divided by 3. So contribution is $3 and the ratio is 2 divided by the total into 2/3 plus, what is the contribution of Pepsi? $1, and the ratio 1 divided by the total into 1/3. So when I do this 3 and 3 cancels out, you get $2, and 1 divided by 3 is 0.3333 maybe. So your weighted average contribution comes to 2.333. This is your weighted average contribution. Now coming to the formula. Formula is simple. Break-even point is equal to total fixed cost divided by weighted average contribution. So if I put the numbers, my fixed cost is $1,000 divided by weighted average contribution, which happens to be 2.333. When we divide, we get break-even point in units. 428.5, we can take it as approximately 429 units. In total, a total of 429 units, including chicken rolls and Pepsi cans. Now you will be thinking, how many chicken rolls, how many Pepsi cans? So we can calculate the split as per this ratio. So if you look at the split, I'm doing it here. Now the question is, yes, we are breaking even. The break-even point we calculated is 429 units. So how many chicken rolls and how many Pepsi cans? Look at the ratio. 2:1. Sum of ratio 2 plus 1 is 3. So for chicken roll, the ratio comes to 2 divided by 3. So it is 2 upon 3. And for Pepsi, it is 1 divided by the total. This is 1 upon 3. Multiply by what? The break-even. So 2 upon 3 multiplied by 429 and 1 upon 3 multiplied by 429. So if we calculate, how much do we get? 286 and 143. Which means if we sell 286 chicken rolls and 143 Pepsi cans, we are going to break even. And when you add these two, you will get 429. So I hope you have understood the concept. Guys, think about it. Don't you think it is such a powerful tool, break-even analysis? We also call it CVP analysis, cost volume profit analysis. What happens to our, profits when we're selling more or less units? Break-even point is so very powerful. The concept is so very powerful for any and everybody who has to do something with business. Whether you are a manager, you are the owner of the company, you are an employee, you want to start up a business, you are an entrepreneur, you're going for a startup, you call it whatever. It is such an important tool that without even investing a single penny into the business, you get to know so much about the business. When you will break even, how many units you will sell to make a profit, how many units if you'll sell if you're going into a loss, how many units you should be selling for sure to break even, that is no profit or loss. How many units is your target? Less than that, there is no way. In our calculation earlier, when I gave you the old example, there was minimum 250 units. This multiple product break even, 286 units every month, 286 chicken rolls every month you need to sell, 143 Pepsi cans every month, the minimum you need to sell if you want to break even. But if you want profit, make sure you're selling more than 286 chicken rolls and more than 143 Pepsi cans. Guys, if you're not yet subscribed to my channel, please subscribe my channel. Press the bell notification button so that you don't miss any upcoming important video. If you like the content, give me a thumbs up and please write in the comment box below how you found this video, because your comment will make me understand whether I need to improve. Your comment will make me understand what topics exactly you guys are interested in so that I can focus my next videos on the same topics. Thank you so very much for giving me your precious time.